Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Friday. It's February 4th. It's the first Friday of the second month of 2022. Don't ask me where the year has gone. I have no idea. I signed a confidentiality agreement. I'm sorry. Friday dad joke. It's 7:44 in the morning. The market's going to open up in about an hour and 46 minutes or so. As you can see here, we're all over the place. The S&P's barely flat. The Nasdaq is up 70 points. The Dow is down over 100 points. It's if this is not random, I don't know what random is. Now, one of the reasons why the market is being this way, I just want to kind of clue you in on what's going on. We had Amazon earnings report after the close yesterday, and first the stock went down 300 points, then it went up 300 points. The bottom line is we're all over the place. I mean, literally all over the place. And before that, we had earnings on Facebook or Meta, or let me just show you Facebook, which was just going crazy. And now it's up a point. I mean, look at these moves, 237, 321, the Amazon moving 11 or 12%. That's one of the reasons why you're having such strong volatility. Now, we're coming close next week, middle of next week. The high big tech earnings are going to sizzle off, and we're going to go into other sectors. So the volatility should stabilize. Now, before I get into my analysis, I just want to show you the big report this week is the employment situation. This is a big report, even though earnings are driving the market right now, and earnings have been better than expected. The numbers have been getting better. The employment situation is going to be big news today. And here's the problem with this report. I just want to show you something. It's a doozy. Look at the consensus, negative 400,000 to positive 280,000. Now, when you see numbers like that, that's telling you that they have absolutely no frickin', excuse my language, clue about what the report is. I mean, they have no clue. This is like throwing darts at the board. Consensus is 150,000. If the number is weaker than 150,000, then the Fed may have some explaining to do in terms of pushing back the bond, the aggressiveness of their shrinking the bond buying. If the number is really hot, like near the 200,000 range, then they could say, well, we told you so, the economy is heating up too fast. Pay attention to the unemployment rate. It'll be a more meaningful number since it's between 3.7 and 4.3. So anything below 3.9 is going to be a big problem. Not a big problem, but a small problem, or somewhat of a problem. Anything above 4.2, again, economy is heating up. So, I mean, cooling off. So the numbers here are backwards. The lower the number, the less unemployment. The higher the number, the more unemployment. The more unemployment, the more America still needs aid from the Fed. It's just that simple, or at least implied. So these are the numbers we want to watch for. The report is coming out in about 43 minutes or so. Pay attention. That may shift the tone of the market. Now, before we get into the stock market, I want you to see the bond market. The bond market, which is what gives direction to the stock market, has been in a very choppy wait and see pattern. Now, if the Fed decides to push back and step back and say, well, we're going to let rates run hot a little longer, there's a good chance we'll break up to the upside. If the Fed data comes out really strong and really solid, well, then there's a higher chance that the Fed is going to take action. And then there's a good chance that the bond will fall down. That means rates are going higher. So the worse the Fed data, the better the odds that bonds are going to go higher. The better the Fed data, the higher the odds that the bond market is going to go lower. I just want you to understand that. I'm going to say that again. The worse the Fed data, the higher the odds the bonds are going to go higher, because interest rates have a lower chance of going higher. You may want to repeat this video if you want to get all the details. But if the numbers are really low, then it's going to imply that the Fed should just kind of hold back and not raise rates 4 times this year, and then the bond market would go higher because rates would go lower. But if the data comes out, if the Fed data comes out really solid, that means the Fed is going to start raising rates, and if that's the case, we're going to go lower. So bad data from the Fed, bad weak data from the Fed, higher bond prices. Good data from the Fed, lower bond prices. I think we're going to stay in this channel for the next month or so till we see if the Fed is serious about raising rates, because I think this is too much too fast. And I think most of what the Fed is pricing in is already priced into the market, at least till probably May or June, especially in light of what's happening right now. So keep your eye on the bond market, especially after the 8:30 report comes out. This report comes out in about 41 minutes. So pay attention, very, very important. Now, let's talk about the stock market. If we look at the SPY, you will see that it's not doing as great. As a matter of fact, let me just put the templates on here. So you can see we're right below, we're right above, we're right in between the 200-day and the 50-day. And if we break the 200-day, it's not a good sign. The fact that we went all the way up here and then bounced back down, that's not a positive sign at all, at all. Now, let me look at the QQQ for you. QQQ's already below the 200-day moving average, and I'm afraid that the S&P may follow along. So this is not good, and if we hit this low again, it's not going to be pretty, because then there's a good chance we can break this support level, which is not good. The Dow, on the other hand, and that's thankfully to the consumer staples and the energy stocks, has actually been doing pretty well. It's been doing okay. So if we don't break this level, we're okay, because we're right at the 200-day line. But I would really love to see the Dow stay in this territory and go higher. But the strongest sector, or the strongest index right now, is the Dow Jones, because it has the most exposure to blue chips and whatnot, and energy stocks. Put the call ratios back at the oversold territory, which means the markets are close to bottoming out. But we could have another day or two of these shenanigans before going higher. But I think we're pretty close to bottoming out. Maybe another day or two left. Usually Fridays and Mondays are rough, and then we go higher on Tuesday. Volatility started picking up again, but I think it will cool off. I don't think it's going to be that big of a factor. Let's talk about global economy a little bit, and then I'll fill you in on some trades and some updates for next week. Shares in Europe, Asia were mostly higher after a historic plunge in the stock market. Facebook parent company yanked other tech stocks lower on Wall Street, and yesterday it was Amazon. First down, then up, all over the place. Shares rose in Paris, London, Tokyo. Hong Kong jumped 3.3%. Holy moly. Traders have been relatively muted this week because Chinese markets have been closed and COVID cases are still surging in Asia. I can't believe that. It's time for it I mean, especially time of year, they're definitely cooling off here. Wall Street major indexes are still on track for weekly gains. Not sure about that. Helped by strong earnings reports from Apple, Exxon, UPS, and Google parent Alphabet, and then Amazon. Thursday, S&P fell 2.4%, biggest drop in nearly a year, weighted by the 26.4% wipeout in Meta platform. It erased $230 billion in market cap, a little too much, easily the biggest one-day loss in history for a U.S. company. As I said, a little too much too fast. They erased 2 years of gains. The stock of other social media companies also fell. I think Twitter's going to go down, and Snap as well. Dow Industrial lost 1.5%, and the tech-focused NASDAQ lost 3.7%, the biggest loss since September 2020. So again, big technology, communication stocks have not been doing well at all. Let me show you, let me give you an idea. So these are the different sectors. Energy still looking solid. Financial, not so good. Consumer staples, I'm loving right now. We're in consumer staples. Financials can still move higher because we have a higher high, and I think we're going to snap back. And these two are the ones that I'm paying attention to. These three are the ones I'm paying attention to right now. Utilities, I think, are going to just kind of drift around here a little bit. Technology, I do not like right now. Technology looks like it can go down for another test. Basic materials don't look that great right now. Healthcare looks like it can just have a few inside days. Industrial is breaking lower. That's not good either. I'd love to see a turnaround today. Communication services, look at that. Almost all the way down. And consumer discretionary, as I said, could not sustain this high. Remember I told you communication services and consumer discretionary are the ones to pay attention to the short side? Well, look at what's going on here. Look at what's going on here. Again, the markets are not technically looking all that great right now at all. The only thing that's looking really good to me is consumer staples, utilities, energy, and financials look somewhat okay. I think they're not going to be too bad, but I do like consumer staples quite a lot here and financials. Now, in terms of next week, you need to watch these levels. You need to watch the 200-day moving average on the Dow Jones, which is at the 35,000 level, and you need to pay close attention to the 460 level on the S&P, and let me show you the level on the QQQ. This is really, really important. The 200-day right here, 366. Again, markets are not looking all that great right now. And again, Friday, a lot of it will depend on the employment situation. I want to see how the markets react to it. That's coming out right here. That's coming out in about 36 minutes. Keep your eye on the bond market, and keep your eye on whether the bond market goes to the upper or lower end of the range. If it goes to the upper end of the range, that means there's a higher likelihood that the Fed is going to do squat. If it goes to the lower end of the range, there's a good chance the Fed will react. So keep your eye on this bond market, which is kind of like right in between these two channel bands, and see which way it goes. And if it starts heading lower, that's bad for the market, bad for financials. If it heads higher, that's actually pretty good for the market and maybe not as great for financials, but it's good for the tech and communication sector, which is really what's driving this market crazy right now. Also, pay attention to Amazon, because Amazon earnings just came out last night, and the stock is as you can see here. I mean, look at this. It's just, I mean, we went here, then we went here. Now we're going to open up at 31.19. I mean, we went from here down to here, all the way up here again, which is just crazy, which is just nuts. But one stock is not going to sustain a rally in the QQQs. So just FYI. I mean, maybe Apple and Microsoft, but not even Amazon at this point right now. Now, I know the market's been going a little crazy, but we've been taking pretty good winners. We took a nice profit on the Dow this week. We got in on 121, which was right here. Right there. We rode this sucker up and we got out right here on 2.2, right there. Look at that. Right there at the high. Got in here, rode it all the way up, got out right here before this little correction. Pretty cool, right? We made about 27.54%, and we did this as a bonus trade for all my discretionary programs. The trade was held for 12 days. And then for another program, Microbursts, we went ahead and we sold Herbalife, and we got out right here. We held it. We got in right there, and we got out right there. We held it just for a day, and we made about 19.44% on that stock in one day. So again, and right now, if you want to know what I'm doing right now, I'm shorting Intel, and we have a little baby profit on it, but I think Intel is going to go down to the base, and I'm going to continue staying short, depending on how the Fed data does. If numbers are looking really solid, I may get out, but if not, I may hold until it drops down. Now, I know this has been a crazy week, but folks, we will get out of this in one piece. As I said, put the call ratio is signaling that the markets are coming off low levels. They're going to go higher. Earnings are better than expected. So I'm looking for potential upside maybe Tuesday, Wednesday, and Thursday of next week. Mondays are rough sometimes. Now, before I let you go, I want to tell you something important. Now, if you guys know me at all, then you know I don't just make predictions and then leave trades hanging to figure it out on your own. I get in, get out, I answer all questions. I'm here to help guide investors and traders through volatile markets by teaching everyone how to manage risk and take advantage of giant opportunities. And boy, oh boy. So Tom Busby, T-Buzz, and I, we sat down to put together a game plan to take advantage of the mega pullback that's happened. And we're calling it the 2022 buyback plan. You guys are going to love this. Click the link below to get the details you need to access the 2022 buyback plan. Do it now. There's a link in YouTube right below this video. It's in the chat box or in the description box. You're going to love this. You are going to love this. Next week, we're going to talk about biggest winners, biggest losers, and I'm going to give you a week ahead preview next week. So it's going to be great. I'm going to give you my top stocks on Monday, my ETFs, and options that I like, and major levels. Do not miss out Monday's video. Follow the link below. Check out this video. Check out the link, to the 2022 buyback plan. Do it now. Have a great weekend and stay out of trouble. Bye, guys.